Today, we find thousands of ETFs in the world. Yet many people don't know what those are. In this video, we'll go from A to Z about ETFs. So let's get started. So let's take a company. You invest in it, everything goes smoothly. Now let's take 9 more companies. It's okay but challenging. Now let's take 10 more companies. Investing in 20 companies simultaneously is painful, difficult and time wasting. With so much data, you just want to throw your brain from a cliff. This is where ETF comes into the scene. An ETF, exchange trading fund, contains many of those companies. So when you invest in an ETF, you invest in multiple companies. This saves you a lot of time. Now there are pros and cons of ETFs, but let's figure out what drives an ETF's price. Of course, individual companies which are in an ETF affect its price. So if many companies decline, the price of ETF will decline. Also, it depends on individual companies. Some companies hold more power in an ETF. For example, in the SP 500, Apple holds around 6.4%, which is highest than any other company. If Apple's shares decline, it will have a stronger effect on the ETF than a company with less than 1% holdings. Alright, what are the pros and cons of ETFs? Well, with ETFs, you don't worry about an individual company. It saves you plenty of time researching, trading, buying, selling or whatever. Second, diversifying your portfolio is one of the tactics you can use to make more money. The idea here is to invest in as many industries as possible. ETFs eliminate this issue because they contain many companies from different sectors. Third, like some individual companies, ETFs pay dividends. So if you own some shares, you will get some money when they pay dividends. For example, last year SPY paid $6 per share to every owner. Lastly, if you invest in an ETF, it's much easier to calculate your tax because it all counts as one. Now let's explore the problems with ETFs. ETFs charge you a recurring fee. The fee is less than 1%, which is not too much, but when you have thousands of dollars in your portfolio, you will be charged hundreds of dollars. Second, you don't have control over which companies to invest in. If you invest $100 in an ETF, all will be divided into companies according to their holding power. Thirdly, the tracking error ratio is higher. Because hundreds of companies are in an ETF, the chances of miscalculation are higher than in an individual or group assets. Lastly, many ETFs just focus on a particular sector, for example, information technology or real estate. And if the overall trust in the sector is down, the ETF's price declines massively. Alright, so who decides what companies to add in an ETF? This is purely based on their rules and procedures. For example, the S&P 500 contains the top 500 companies in the US, and every quarter their team evaluates companies and removes and adds them accordingly. Now with the basic idea cleared, let's go a bit deeper. ETFs do not just track stocks. Many ETFs contain bonds, stocks and other commodities. So while investing in one, you need more research. But the research is mostly one time, which is time saving compared to researching hundreds of companies. Also, ETFs are like stocks, so you will find them in your investment app or your broker's website. You will buy an ETF as you do an individual share. So if you apply this knowledge to other ETFs, you will have a proper idea of their functions, assets and pretty much everything else. With that being said, it's time to finish this video. Thanks very much for watching, and please let me know what you think of ETFs in the comments and smash that like button if the video helped. I'll catch you later. Happy investing.